Right, so everybody, welcome. And this is the Carolina Multifamily Connection. We meet every first Thursday of the month, virtually, obviously, although I am getting ready to maybe plan a in-person, do quarterly, maybe one up here and then one down in the Carolinas. So the theme creation, the reason I created this is, during obviously COVID time, it was an opportunity using Zoom and all the virtual platforms to connect with people you normally wouldn't connect with. And the idea kind of came to me that I couldn't be the only one sitting up here out of state looking to connect with other investors. So that's been, the idea, connecting out of state investors with Carolina based investors and operators. So typically our guests will have the tie to now North Carolina, but everybody here is welcome. So it's great. Today, John is our guest, John Blanton, and he is based in Raleigh. He's also a multifamily investor, but also, as we'll learn, is a entrepreneur. So as we were just chatting, we'll invest in anything that makes sense, I would assume. We'll give you a little bit of his bio. Uh, John guides people to a life of fulfillment by independence faster through business acquisition. He's helping identifying earning opportunities by thinking differently. His contrarian approach to investing has led to numerous highly profitable exits over his decade-long career. He credits these large risk-adjusted returns to his ability to source deals and his expertise in performing thorough due diligence on real estate and business opportunities. In 2020, he launched his Lifestyle by Design podcast, Contrarian Cash Flow, to open a dialogue about what it takes to create a fulfilled life while on the investing entrepreneurship journey. A dedicated father and loving husband, he believes the best deal he has closed is his wife. More about him, and I'll drop. He has that up in the chat, but that's a good one. I'm sure your wife was happy the first time she heard that one.
Cool. Well, yeah, thanks, man. I really appreciate you allowing me to share your stage and, excited for everybody that's here. So definitely want this to be as interactive as possible. So if you have questions or anything, drop them in the chat or, happy to answer anything. So I'll give you a little bit more color to my story and my background. So like a lot of folks, I kind of was aspiring to this, what I thought was this American dream, right? You go to college, you get a degree, you get a high pay, you get a job, start climbing the corporate ladder, start making a good salary, and you start putting away as much money as possible into your retirement fund. And then at 65, you just ride off into the sunset, right? So, I'm sure a lot of people here are kind of, either following a similar path or, thought that was the path for them. And as I started down that path, it just wasn't lending the results or the fulfillment or the satisfaction that I really felt that I was going to, right? And I think that's when I really started getting involved more on investing and pursuing more entrepreneurial ventures, trying to understand, what do I really want to do? And can I have more control over my ability to earn income? And so there were a couple instances in my life that kind of started pushing me down the path, especially real estate. And I've kind of been able to expand even since then. But the first one was I was actually unable to put the amount of money I wanted to in my 401k plan. So the way my wife and I were classified as employees, it was called a non-discriminatory 401k plan. And so we were only able to put 3 or 4%. So for years, we had been putting in the max into our 401k plan. And then all of a sudden, out of the blue, it's like, oh, you can't do that anymore. And it's like, wait, what? This is what we thought we were doing. We were just so fortunate and happy that we were like putting in the max. And so then we all of a sudden had all this additional capital piling up and we're like, well, what are we going to do with it? It sounded like, everyone's always thought about either opening a gym or a restaurant, at some point in their life. Like, that sounds cool. And we just thought that, the failure rate was so high and, we didn't know anything about either of them. I had worked in a gym before. And so I had some idea, but obviously that was more time with a growing family and a full-time job. And so that's when we kind of started looking at real estate. So super naive at the time, we just were like, oh, the 1% rule, that makes sense. So it took us about a year. And this is, 6 years ago in Raleigh, right? So, I mean, the market was strong and, it was recovering, but it wasn't anywhere near what it was now. And even back then, it was very difficult to find that 1% rule. And by no means were we very aggressive. It was like we talked to a couple residential brokers, and if they found something that looked reasonable, they'd send it to us. And so we fell into a couple properties near NC State, and and those started performing pretty well. And so then from there, the market started to take off, and this is probably like early 2017. And so for a couple years, same thing, just wasn't really being very committal in actually pursuing real estate. And so after a few years decided, hey, I've really got to take more control over the situation. And so I did a private lending deal. So somebody had done a flip, and they were referred to me by actually the woman that had sold me the condos or sold my family the condos. And so she said, hey, I've lent to this guy before. He flips the house and then he pays you back. And so I did that, and it went extremely successfully. And I was like, well, this is pretty cool, but I made money. I didn't really do anything, but hey, look at how much this guy made over here. Let me see if I can actually flip the house and kind of go through that process. And so, kind of about the same time at my job, I had been promoted the year prior, and then due to a corporate restructuring, I ended up getting demoted. I'd hit all my targets. I had hit all the criteria that they had expected of me. And, I'm sure a lot of folks can kind of feel that pain, right? Corporate restructuring, company changes, leadership changes, and all of a sudden, I'm demoted, and I have the bonus that I was able to accrue and capture before was no longer there, right? They're just like, hey, we're demoting you. You no longer have the ability to earn this, right? And so that was really an eye-opening experience in my life when I said, oh, wow, like, I had done everything I thought that I needed to. I hit all the metrics. We hit all of the expectations. And, within 2 months, they're just like, hey, that's not going to happen. You're not going to be able to do that again. And so that really kind of gave me the fire to start looking and being like, hey, how can I do this? But I still had that limiting belief in my head, like, can I really make money outside of a job? That's all I've really known, right? I'm working for somebody else, making a paycheck that way. So, so I done my first flip with a partner, and it went very well. We didn't make a ton of money, but it was successful. It was pretty smooth. The property turned out very nice. This was in Fayetteville, North Carolina. So then I was like, that was cool, but I split whatever we made, right? It was 16 grand. And so we both made 8 grand, right, within 6 months. So I was like, okay, that was cool, but maybe I can push this more. And so I tried to take on a flip on my own where I was going to run GC on the project myself. And, it was, a calamity of errors, right? And thankfully I made it out alive, but I only made up like 16 grand, and I probably blew 30 grand, right? It could have been a huge deal. And I ended up just squandering money to sob stories with contractors, or just really naive rookie mistakes. And so, but the point of that story was that I saw like the ability that I had to actually create income outside of a job, right? 16 grand, I busted my butt. I probably worked way more time in the project and was way more close to it than I needed to, but it was like such a sign of accomplishment, right? The money didn't really mean much to me, but it was more of the fact that like, oh my gosh, like, I didn't know anything about construction. There were so many challenges that came along the way. I had to fire the woman that we worked together, right? And we were working together on another project. So it was like extremely uncomfortable, it just ended up not working anymore. But I made it through, right? We made it through the transaction. The ironic thing is the person that bought it actually worked for my largest customer, and the broker actually used to work for the same company. So it was like kind of this like full cycle story, right? Where it was like this ecosystem of, people that in my career, their career, and in the transaction ended up happening. And so after that, I realized that, I need to find a way to make income that I can kind of detach myself from the scenario, right? And so I think that's from both either the job or the flipping. It was like, I'm still trading my time for this money, right? And so I started that's when I kind of started looking into multifamily. And I was kind of sucked into syndication pretty quickly, and I jumped into a couple deals, and that was great. And I think syndication definitely has a place in people's portfolio, but what I realized, it was probably slower than the time frame that I wanted to get there, right? It's going to take 10, 15 years, even if you're putting in 50 grand a year, to really get to a point where you can make a big dent in your personal expenses. And so so that's when I started looking at multifamily. And so I was, I'm a sales guy by trade. And so I'm pretty stubborn. So I just started cold calling owners. And, fortunately, after about 6 or 9 months, I was able to run into a couple properties. And so I bought those late last year and spun out of one pretty quickly and just sold it because it wasn't really the fit for what my investing criteria was. And, we're in the process of turning the other 14 units right now. And, that was kind of a really fun experience because it, showed me, and then the amount of revenue that's getting generated in cash flow from the property is like, enough to kind of overtake some of the expenses that we have in our life. And so, a lot of the reason that Jerry wanted me to come on here is, since COVID hit, my wife and I really looked at each other and said, let's like put the pedal to the metal. Let's really see where we can take this thing. And so, fortunately, her and I are, she's the most competitive person I know. Maybe I'm a close second, but she's just very hungry and always ready to kind of take on the next challenge, and extremely supportive. And so throughout COVID, she actually ended up buying a pet sitting business. And then since then, she's actually acquired another fish retail business that Jerry and I were kind of talking about before. And so we're just kind of trying to dabble in these different areas and different, means to make cash flow. Right. And so the point that I was kind of telling that story was the reason that Jerry wanted me to come on is just talking about cash flow and entrepreneurship and really how it fits in your goals full circle, right? Because I think a lot of times people see a new investing strategy and it's the shiny toy, the shiny object syndrome, right? All of a sudden they're like, oh, that's syndication, that sounds great, or oh, multifamily, or oh, whatever the case is. And really, I think it comes down to, what do you really want from life? Do you want, being your own boss is a lot more responsibility than I think a lot of people give it credit for. It's cool to say, hey, I'm going to do whatever I want all day, but you have to actually define what you're going to do all day. Right. So I think that's a lot more challenging than people realize. And so that's why, I kind of started working through this thought process of what I call the cash flow stack. So I'll kind of walk you guys through he's not letting me share. You mind giving me access to share?
So yeah, I'll before I do that, I'm going to add to it that, one thing was interesting, you talked about syndications, you talked about different types of multifamily investing, but, whatever your goal is, a lot of it is you have to define what it is that you want. And that's what kind of struck, the conversation that we first talked about this with the cash flow stack. And whether you're preparing a personal financial statement or whatever it is, you have to be able to look at and start to itemize and be aware. You can't track what you don't, keep, see, I guess. So that's one of the things that's awesome that I'm looking forward to getting more on.
Well, I think it's so interesting is we always define it based off our net worth, right? When in reality, our net worth doesn't really define anything. Even when you think about your retirement fund, right, or your retirement plan, you're putting money into this 401k. But ultimately, what do you want it to do for you? Generate cash flow, right? If it just sits there and it's not making any type of yield or anything, you're just peeling it down. And then, it's one of those scenarios that you're hoping you die before you run out of cash, right? And so I think that's like kind of the irony of a lot of this stuff is like save for retirement. But once you get to retirement and, who knows what the future holds, right? We used to have the 4% rule, right? The safe withdrawal rate where you could pull 4% per year. And if you were in really stable investment products, you'd be able to just live off that means forever, right? And, I think it's highly questionable if that's going to continue moving forward. If a 4% yield, or depending on how aggressive you're going to have to get in your portfolio. And so I think that's kind of the synopsis and the thought process is if we start thinking in terms of how we're making income, cash flow, as I call it, and how efficiently we're making that, are there levers that we can pull throughout the process from both a labor or your time perspective, and then also from a tax efficiency perspective, because, that's really what it delves down to is how can you be able to make the most money in the least amount of effort with the most tax efficiency, right? That's kind of the perfect way to make money, right? And so, so that's kind of where I started walking through this this template. And so it's a little bit of a play on the cash flow quadrant from Robert Kiyosaki. But so the thought process is the stack breaks down the different areas in which you can create income, right? So W-2, the majority of people understand that, right? So you're usually you're employed for somebody else. And so your paycheck comes in every 2 weeks or every month or whatever the time frame is. And it's the least efficient from both a labor and tax perspective. If you're not working, you're not getting paid. Of course, you got time off and whatever the case is, but if you're not working, 40 hours a week, 45 hours a week, whatever, right? Or if they end that engagement, you're no longer getting paid, less severance or whatever the case is, right? The other challenge with that way to create income or cash flow is that they're really minimal tax efficiencies, right? And especially once you have children and once you start being able to create a higher income, there's a lot of thresholds that you cross that you're not able to take certain deductions. And so I think that was kind of eye-opening for me when I started creating income from real estate, both actively and passively. There's a lot of benefits that I could take individually, right? Either using my car or buying things that I needed for my business, but then also I would be able to use them and leverage them from a personal perspective. If you have a W-2 job, you can't write off, buying something for any other means, right? Maybe if you do some educational products, you have, some little bit that you can write off, but it's still such an incremental and minimal amount. So obviously, as you get deeper, you become more efficient. And the thing with W-2 is most people don't necessarily have control of what they make, right? You're making a set hourly rate. Maybe you have an annual bonus, but regardless of how hard you work or whatever you do, you're kind of making that set amount. So that's why as you start working and getting into 1099, so that's more like an independent contractor, right? So you either do some type of consulting work, you're doing something where you're not dictated, day in and day out what you need to be doing. You're not working for somebody else. You're working self-employed, right? This is the self-employed space. And the reason that I think this space is pretty intriguing, and especially to most people, is I guarantee all of you out there have some aptitude, right? That you can help others with, be it, maybe it's more technical, maybe it's more qualitative, but the nice thing about 1099 is you can start taking advantage of some of those tax benefits for, certain write-offs. If you need to buy a computer so that you can do that, right? You can write that, I'm not a tax professional, but there's certain benefits that you can take on, or there's things that you can use for your personal life that you can write off through your income through 1099. And the other thing about 1099 is you can set the rate in regards to what you make, right? So you're not becoming more labor efficient. And that's kind of the trade-off between W-2 and 1099. 1099 is not really any different. If you're not working, you're more than likely not getting paid, at least how I kind of, in my definition. But the nice thing is you can become more efficient from an hourly rate perspective. Instead of making $50 an hour, you can charge $100 an hour, right? And now you're making twice as much. So really you're getting twice the benefit in the same time frame. And then, really when it gets interesting is when you start going deeper into the business side, right? And that's kind of my favorite spot to be within the stack, right? It's not as labor efficient as entirely passive, but the thing about the business side is the write-offs and the ability to leverage other people's time, right? Everyone talks about other people's money, which is great, right? You need to use debt. You need to use ways to leverage other people's money to buy your investments and to kind of propel yourself forward. But really, when you start using other people's time and they're working on your behalf to make you money, that's just such a powerful tool. And so the business side for me is there's so many levers that you can pull, right? You can hire people to do jobs for you and then pull back the amount of time you're putting in. You can obviously, and everyone understands multifamily value add, right? And especially when you're an active operator, even if it's a smaller opportunity, there's a lot of tax benefits for being a real estate professional, and I was fortunate enough to take advantage of some of those last year. We had done a cost segregation study on my property, and it wasn't even a huge purchase. It was $400,000, and I got a $75,000 tax deduction. Just straight up, right? I mean, not a tax credit, but a deduction off of our taxes, right? And that was a substantial difference. I mean, that made a big difference. And there were other write-offs that I was able to take against that, right? And I think that's why, the business section is so interesting. And then, another kind of tidbit, and again, talk to your tax professional, right? I'm not giving any advice, but on the business side, if you can leverage your vehicle for that, you can take a full first year bonus deduction of your vehicle value or the purchase price, right? Which it was just extremely powerful. So we took advantage of that, and we purchased my wife a new car, and so we were able to save 20% off the price from a tax perspective because we were able to follow that section 179, putting the vehicle into service. So, that's for me why the business, I think that the tax benefits from the business segment are the most powerful. You do have to still work, right? I mean, unfortunately, there's not a lot of businesses that are just entirely turnkey where you don't do much in them and they continue to be successful for you. You can take your foot off the gas on a business and it'll go in the tank. And so I think that's one of the things about the business side is it still does require you to be present. But for me personally, the amount of upside that it offers to you and the number of levers that you can pull to create success, I think, for me, that's kind of where I like to live and where I recommend people that are looking to create and generate more cash flow and really more in that accumulation of wealth phase versus the preservation phase where they really should hang out. And then lastly, there's passive, right? Which the majority of us know about passive. So that's really when you're doing not much of anything, right? You're writing a check and then you're just sitting back and collecting checks as they come in. And that's tremendous. And as I mentioned, I'm an LP in a handful of deals. And I think it's a great way to invest, and especially a great way to diversify your portfolio to invest. The challenge with passive is depending on, how aggressive you want to get on your taxes. If you're not a real estate professional, some of the tax benefits that are championed, aren't necessarily as positive for a non-active operator, non-real estate professional as they are for a real estate professional. And same thing with the passive side, the returns aren't quite as great either. Right. So an 8% preferred return or a 15% IRR, that's a solid return. Right. But if you're investing $50,000 into a deal, that's $333 a month. Right. I mean, how many $50,000 investments do you have to make? And I think that's kind of one of the funny, again, I'm a passive investor. So, I mean, I'm kind of poking fun at myself here too, but so it takes you a year to be able to save enough money to invest 50,000 or maybe 2 years to invest $50,000 into a deal. And then it makes you $333 a month. And they're like, hey, this is really efficient. It's like, wait, it just took me 2 years to make $333 a month in passive cash flow. Right. But again, that's the trade-off that you're trading off, right? You're not working at all and somebody's just generating this for you and to kick it out. So that's kind of just the synopsis. And again, as you go through it, you become more efficient. And that's kind of how I recommend people to start looking at their, how they're creating income, how they're creating cash flow. And the other kind of caveat and piece to that is I would highly recommend looking at your monthly net, right? So it's great to say, hey, I make 100K, I make, 80K, whatever I make, but how much are you actually taking home? Because that's really all that you can spend, right? I mean, if you're taking deductions for your 401k, if you're taking tax deductions, if you're taking whatever these other deductions are, these payroll deductions out of your check, I really recommend that you should look at it from a net perspective, not a gross. Hey, I make 100K, I'm going to say, I make this, right? Well, it's like, what's your paycheck every 2 weeks or every month? Really delve down into the net. Because same thing with your expenses, if you're looking at the expense side of the equation, you need to know what your actual expenses are, right? You're not just like, well, it's kind of this, it's like, no, I mean, every month my mortgage or my insurance or, my kids' daycare, whatever the case is, right? You know exactly what that amount is, or at least if you don't, you should, you should delve in on your expenses a little bit. But I hope that gives a little bit more color to what I'm kind of working through and what I'm thinking through. So does anyone have any questions or any thoughts or?
I'll jump in. One thing is interesting, and I too am a LP investor, and definitely syndications is I think part of the pie. But yeah, if you think about it, you take $1 million and it's invested at 8%, you get 80,000, and depending on what part of the country you are in, that may not get you too far. So there's multiple ways to do this. Now, one thing I definitely want to touch some of your entrepreneurship endeavors, if you will, but you mentioned one time the difference between financial freedom and financial independence, and I thought that was a pretty powerful topic. You want to go into that a little bit?
Yeah, absolutely. I mean, so this one's tough to me because now I'm kind of even moving away from financial independence because of I'm kind of more financial abundance, right? Because I mean, it's like if you quit your job and you're living on ramen all the time, is that really independence? I mean, we want to live abundantly, right? We want to live in Jerry's house right there, right? I mean, that's kind of where we want to be, right? And so, yeah, so financial freedom first versus financial independence. And so the reason that I prefer the term financial independence versus financial freedom is, unless you're going to go out into the woods and, live on berries and, forage around, you're going to have some dependency on finances, right? Not that they're going to dictate your every move. And that's kind of why you want to move more into the independence side. But, I think that's why I don't really like the financial freedom, because we're always going to be tied to finances. I've got children, I've got my wife, I mean, they require, certain amounts and investments, and I know I spend, decent amount on stuff myself as well. And so I think that's why, freedom from it is really, in my mind, impossible, right? We want to become independent. We want to be able to make our decisions and dictate our life independent of finances, right? Hey, I want to go, stay a week at Jerry's house. Hopefully, he'll accept me on my Airbnb recommend or invitation. But, and so, I mean, things like that, you want to be independent to live the life that you want. And that's why, I mean, again, it's kind of semantics, right? Financial freedom versus financial independence. But I guess that's my thought process is, how do we get to the point where we can, make the purchases that we want, that we can take the vacation that we want, that we can go to the restaurants that we want. And that decision is independent of what the cost is. Right. And I like to be fairly conservative myself in our spending, but, we like to take vacations where we want to go. Right. And we don't want to be worried about, oh gosh, like how much is this going to cost? It's like, that's where we want to go. And that's what it costs, and my wife's a lot more, she's getting me there, and I'm, I've always kind of, I guess it's more like my dad. He just always was like that, kind of like chintzy. And it's like, yeah, like just, this is life, right? We want to be happy. We want to have fun. We want to do things within reason. And, we're not staying at the Taj Mahal or the nicest place. It's just like, hey, if we're going to go on vacation, let's enjoy it. Right. And not worry about the finances. And so I think that's where the independence kind of comes in, is you're not fretting over spending money on things that you really want. Right. And again, that goes back to defining what you ultimately want. If you're spending money on frivolous objects and, cars and houses that, really are more opulence versus, what you really should be living in or what you want, and it's more for ego versus, what you really want from your life, then that's something you'll just have to, determine what's important. And if the big house is important to you, by all means, that's your prerogative, but the mortgage balance that's gonna follow it as well, is going to be on your shoulders. So I think it's just goes down to what's important to you. And I've never been a car person, and like I said, I've got 2 kids, so any car I get, becomes instantly trashed, and so so it's not really as important to me. But I know a lot of people that love cars, right? They want to drive a nice car. That's totally fine. But how does that fit into your independent mentality? Do you have enough income or cash flow coming in from different sources that you can cover the car payment or, buy it outright or whatever you want to do? So, yeah, so that's kind of the difference in my mindset in regards to financial freedom versus financial independence.
Yeah, listen, it's a nice intimate room, so anybody wants to just jump in, just come in with a question. Also, remember to use the chat over there. You can use the 3 dots to save down at the end. Well, one thing I'll, just the word comfortable and being uncomfortable. I think looking back to last year, everyone's life obviously changed, and I live in New Jersey. I go to the city, so I commute. Every day you get on a train. It's just that's it, and then boom, you're home, whether you're sitting in the living room, with people around you. So, if you're looking to go a certain route, whether it's get out of the W-2 world, or there's going to be a level of uncomfort at some point where you're going to have to step off or step away, or do something like talk a little bit about that, and then that probably segues into taking chances on businesses and things like that nature.
Yeah, absolutely. Well, and I think that's the thing people gloss over a little bit sometimes, is like you reach this financial independence stage and it's just like euphoria, right? You're just like, hey, I'm there, and you're just, everything, all your troubles go away. Your life is just perfect. And I still had that limiting belief, we were fortunate enough to kind of reach financial independence late last year based off, our circumstances, our investments, and this new deal that I had gotten and everything. And my wife, like I said, she had bought that pet sitting business. And so, we had kind of reached that. But in my mind, I still felt, this disbelief of like, can I really do this? Can I really be successful? What if I actually leave this job? Right. And I think that's the challenge the majority of folks are going to have to get over mentally. And, I just, in my mind, what really got me there eventually was, if not now, when? Right. Am I going to sit back in 10 years and say, oh my gosh, I should have tried this? What if I would have done this differently? Because if I look back at everything in my investing career, what do I tell myself? Man, if I would have started this 3 or 4 years earlier, I'd be done a long time. I mean, just think about it. If any of us were as aggressive in terms of buying multifamily real estate 3 or 4 years ago, we'd probably all be retired, right? But it took us a little bit longer, which is totally fine. And, and now here we are. And so I think that's really was more the mindset, and the thought process was, what's really the downside scenario? What's the worst that can actually happen? right? It's like, okay, I try for a year, 2 years. I can't make anything happen. We lose some properties. We lose some income streams. I have to go back and get a job. Is that really the worst thing to happen? Is that the worst case scenario? I'm still so fortunate. I'm so blessed. I've got two beautiful daughters. I've got a supportive wife. We've got a great life. So, I think that's really the big thing on both sides, right? Can you handle, understanding that every day you're kind of responsible for your own actions, and, and you're not going to keep getting that paycheck. And so finally I just, decided that it was kind of time for me to ride off into the sunset. And I think that was the biggest thing in my mind that really stood out was, if not now, when, right? But we had taken steps. This is a 5-year process, right? It was not just like, hey, John said he's going to quit and then he just jumped ship. But, I think it was one of those things. If I'm going to succeed, what's another 50, 100, 200K or whatever it is in my pocket over the course of my life? For me, it was more, hey, can I handle this and the challenge, and listening to other people that had been there. And honestly, it was like a little bit of an ego thing. It was like, they're like, I've been through all this, for lack of a better word, shit, all these struggles. And I'm like, am I tough enough? Right? Can I handle that? And I think that's really what pushed me to really be like, let me get out my comfort zone and let me see where I can really take this and kind of really reach for my potential, instead of just, I was lazy. I was lazy and complacent in my job. And so I think that's really what kind of pushed me was, it was great not working very hard and making good money, but I knew deep down that that's not who I was as a person, or who I wanted to be. So again, just looking at your circumstance and understanding yourself, where you want to go. And my aspirations were much farther, long-term than what my job could ever offer me. And I wanted to be in control of my income. And so that's kind of what pushed me ultimately to deciding to make the leap. And, so far it's worked out. I've definitely had more challenges than successes so far. But again, that's why, having the different sources of income coming in, having, for me, again, a supportive spouse. It's not just me by myself, right? So, it's not just the John Blanton show. I've got a great wife, and she contributes a ton. Actually her businesses are starting to kick my butt a little bit, so it's a little bit of a household competition. And so, but that was kind of the thought process into getting into the businesses too. And I think that's kind of when you look at the cash flow stack, or just different asset classes of businesses versus real estate. There's other asset classes outside of real estate that cash flow a lot stronger than real estate does, but you're not going to have the same appreciation upside. So just like a basic example. So businesses are usually valued at a 2 to 3 times cash flow multiple, whereas real estate's like a 15 to 20 times multiple, right? So if you increase the property value by $1, you're getting a 15 to 20 times gain. If you increase the value of the income of the business by $1, you're getting a 3 times gain, right? But if you kind of invert that and think about how much cash flow you're getting, you're getting 1/3 of the value of it versus 1/20th. And so I think that's what's an interesting thing. Go back to defining your strategy. Could looking at acquiring a business be a better means to get closer to financial freedom, and then have, and that's kind of the way we're going, is we want to have real estate, but we also want to have businesses, because we do have more levers to pull within businesses to gain, further cash flow and increase the value of the business. And it's a little bit more interesting to me than real estate. I love real estate through and through, but there's it's kind of a tried and true method, value add. It's like you go in, you purchase the property, you do the repairs, you get it up to the market, and then you either, refinance it or turn it over to somebody else. Whereas in businesses, there's just a lot more levers to pull, which again, that means there's potentially more risk as well, right, to the individual. So, we just trying to see, what works for us and what doesn't. And I'm sure we will continue to make a ton of mistakes, but I think that's kind of what's the exciting part of both business and real estate. And again, if you're an active operator of a commercial property for real estate, I consider that a business, right? So I kind of encapsulate that. I'd say a rental property or individual or a duplex or something of that sort. I kind of, put that in a different realm. But again, if you're actively the one self-managing that, then I think you can't argue that's more of a business investment than just just a passive rental property. So, but yeah, I'll jump in. So I made the cash flow stack kind of visual, and I was like, I need to find a way to actually start tracking this a little bit better. And so I'm not an Excel person by any means, but I was fortunate enough to have some people help me out. So I created this thing called the cash flow stack. And so what it So what it is really a breakdown, and it's supposed to be an easy visual representation, and maybe easy is not the right word. It's supposed to be a visual representation of the different sources that a household would have coming in on a monthly basis, and kind of where people are, right? So if you so I know you asked about independent versus freedom before. So if you look down here, this cash flow versus expenses cell. So I kind of have it as people move through the process. So initially they're job dependent. If you quit your job, you wouldn't have enough money coming in from other sources to pay your bills. And so you'd be going into debt. So you're job dependent. And then eventually you make it to independence. And so that's when your income from other sources surpass your monthly expenses. And then your discretionary, when you're doing pretty well, you have enough money to take trips and do some fun stuff, and then ultimately I kind of turned it when you're 2 times your island living. So you're doing pretty well when you've got 2 times the amount of money coming in from different sources to cover your expenses. But so this is kind of a breakdown, and I'll come back to this page. I just wanted to show the summary page because it's a little bit visually more exciting than the next 2 pages. But so what I did was I kind of broke the stack down into the labor and tax efficiency. So if you look at your different sources from the stack level, you look at the W-2. So from a labor efficiency perspective, it's the least labor effective, right? Because you're trading your time for dollars. From a tax efficiency perspective, it's also the least effective because there's minimal write-offs and deductions that you can take against that source of income. Then if you start getting into some of the different passive means, right? So you get into the rental property, you get into a syndication, a passive LP investment, you get into the consulting piece, you get into the business piece. So then, okay, so this is meant to be a synopsis of a household and their different income sources. So both of them are currently working W-2 jobs, but they also have a couple investments. They have a rental property. They invested as an LP in a passive deal. And then one of them has a small business. And then one of them works some independent contractor roles. So I'll come back to this in a second, but this is just kind of a basic synopsis of how, I kind of look at capturing what your monthly cash flow coming in is, and then also what your amount of effort you're putting into that is. And so the other thing is here on this cell, you see how, again, I kind of equate it back to your monthly net, how much is actually hitting your checking account every money market or wherever your funds go. How much is actually hitting your account on a monthly basis? Cause that's really all that matters. Cause that's what you have that's spendable. It's not, hey, my gross paycheck is $8,000 a month or whatever. That's great. But unfortunately, you can't spend your gross. You can only spend your net. And so then if we get into the next cell here, or the next sheet here, so really it was meant to be also a expense document, or expense tracking and expense ratio document, right? So on this page, you can go in and enter your different expenses. So your mortgage, your food, your gas, restaurants, entertainment. There's a bunch of different cells. And so it was kind of meant to be able to track your budget. I think in general, most people aren't great. I obviously could get better myself at tracking your budget, but this was meant to be a tool and an easy tracking ability to say, hey, where's my monthly cash flow coming in, or what are my monthly expenses? And then how do they relate to one another? And so, when you can start pulling some of the levers, and so these are some of the ideas from the cash flow stack that I would kind of implement into looking at somebody's situation and what should they really do to create more income and work less hours. So look at both of these spouses. They're working for different companies, very, very creative names, obviously XYZ and ABC company. But they're both working 40 hours a week. So is there a way that they could continue that job, and could they lower their number of hours that they're working? Could it be something that they're working in 40 hours a week, and now they can work 35 hours a week, right? Boom. Now all of a sudden they've got 5 extra hours. It doesn't necessarily have to be on a revenue generating task. Maybe they're spending more time with their kids, or maybe they're, doing an activity that they enjoy throughout the week. And so I think that's kind of the thought process I want to start having people have. Or the opposite of that is they're still working the 40 hours, but is it possible for them to make $5,500 a month instead of 5,000, right? Boom. Okay, great. Now they're giving themselves a little bit more of an increase as well. So when you start getting into the business side, I think that's kind of where it's exciting because, is this individual business in 1099, right? Same thing. So, hey, could somebody on the 1099 side, could somebody, instead of charging, making a net of $500 a month, could they start making a net of $700 a month, right? And then boom, okay, now all of a sudden they're making almost $54 an hour. Or on the business side, maybe maybe you have to hire an employee or outsource some task, and now you're only making $1,500 a week. But what if now you're only working 1 hour a week? I mean, and that's kind of the thought process that I want people to start going through is like, okay, before, how much were they were making $35 an hour. And now if they can outsource a task, and again, that's kind of a extreme example, we'll make it 3 hours instead. But look, they've tripled the amount that they're making from an hourly perspective. And so I think that's the thought process that I really try to help people kind of start getting through is how do you become more efficient? And not only that, now they have another income source coming in that they can deduct, expenses through if they so choose. And then we'll go back to the main page. And so then this is just kind of a basic synopsis kind of across the board of, where somebody is, what their monthly net is. And so as you can see, this family is doing quite well. They have a good, strong income coming in on a monthly basis, but 76% of their income is tied to that W-2 source, right? So if either of those spouses were to lose their job, this number on the monthly cash flow versus expenses would start to creep down quite a bit. So, but yeah, that's kind of the cash flow stack and the dashboard, and yeah, kind of in a nutshell. So.
Yeah, that's awesome. I think it's also great for, those, if you have one or different sources of incomes, like just to be able to see it and visualize it in one place. So that's an awesome. Now, is that something that you're actually looking to do as far as like a consulting, or this is pretty high level that I like it?
That's something I'm still trying to figure out. That was something that the kind of the educator path was something I thought I was going down. And then I realized I'm more of a doer. I like actually being in the weeds and actually trying to run the deals and do deals and stuff like that. So, anybody can go to my site and, and download that for free. So if they want to check it out, feel free to hit me up if you have questions. But yeah, that's one thing. I've kind of gone a little bit more into the coaching side and really trying to help people define what they want as that outcome and then start implementing those tactics, be it buying a business, buying multifamily, but what really ultimately is that outcome that they want, right? Is it time freedom? Is it more time with family? Is it the nice car, right? It doesn't necessarily have to be the same for everybody, but I think so few people really define, what do they really want from life and what are the outcomes that they want? And for me, time freedom and control over my income are two of the most important so that I can spend time with my family, with those that I want. I don't have to take calls or do certain things when I don't want to. I still have to do a lot of things I don't want to do for the businesses or for the real estate, but it's still my prerogative. I could choose not to do that, right? If I so chose, versus not that I couldn't choose in a job either, but, I guess I just feel like I have more control for me personally over my ability to earn income. And so, but yeah, no, I see Titus had thrown a question in there about finding partners as well. And so, I guess, as far as partners, I'm assuming, are you saying people that you'd want to JV with or work together on a deal? Or do you mind giving a little bit more commentary on what type of partners you mean?
Yeah, I'm here. Yeah, basically to partner up to get into multifamily. It's been a struggle to find someone to partner up with, to go in and to make a deal happen, basically.
Yeah, absolutely. Well, the first point that I would kind of make is, why are you looking for a partner? What can they bring to the table? And I think that's I think partnership sounds, a lot sexier than it really is. But like I had alluded to earlier, that general contractor was my partner on a deal and it got sticky really fast because the first one was super smooth and people change, things change. And so, for me, I like to have deeper relationships with people before, we really start making it more of an official, kind of, I guess, date before you get married kind of scenario, just because when you start doing business together with somebody, it's entirely different than just being friends with them or just, even kind of going through basic scenarios. And so, so what I would say is just make sure that you look for people that are bringing things to the table that you don't have, so is it capital? Is it deal flow? Are they analytical and you're more of, kind of the deal sourcing person? You don't have problems talking to investors or brokers or things like that, but staring at spreadsheets, kind of numbs your brain. Right. And so I think that's kind of my biggest recommendation for when you're looking for partners in regards to how about finding them. I think you turn that on its head and you say, what are you good at? Right. And you need to start showing people what you're actually good at, what your aptitudes are, what you're going to bring to the table, and find people that you can have synergies with. Again, are you more the analytical person? Are you more the deal sourcing person? Are you the capital partner? What can you bring to the table? I think meetups are a great source to find those as well. But depending on the market you're in, maybe just kind of looking through LinkedIn or looking at different sources that people are out there and really just trying to reach out. And I know everyone's like, just say, I'm willing to help, right? Well, instead of saying you're willing to help, tell them how you can help them, right? Because reaching out and saying, I'm willing to do anything, it's not really helpful. You're already putting a burden on the person because they're having to define what it is they need help with, right? So try to find people that are looking to do things that you want to do in those markets that you're looking to attack, and show them what value you can actually bring, and say, hey, I've underwritten 500 deals and, these are the ones that I thought were good. And, I just, for whatever reason, wasn't able to secure them. Or, hey, I've cold called 1,000 multifamily properties in XYZ County, and these are the conversations I had, and this is kind of what I've been doing. And so I think, that's what, that's what I would start doing is show off your talents and really share with that person why you should be a partner with them, not kind of asking them, hey, do you guys want to partner together? It's like, hey, if you don't want to partner with me, I'll go find somebody else kind of thing. But yeah, that would be kind of my recommendation. Due diligence on evaluating a business for cash flow. Yeah, absolutely. So that's going to be a very long-winded answer, but I think you just need to look at things and look where there could be opportunities for efficiencies, right? And so one of the numbers that's really telling to me is there are $4 trillion worth of baby boomers in the United States, with small, but the value of small businesses that baby boomers are holding today, right? The value of them. And so you can just imagine, how many of those are still on pen and paper, or, kind of handshake agreements, or, are there any ways to systemize, automate, bring those businesses into the 21st century? And so when you're evaluating a business, I mean, it's very similar to multifamily. You have to have a good idea of the numbers of a business. Does that payroll expense make sense? Do those insurance numbers make sense? I mean, it's very similar. The thing with businesses is there's a lot more nuances, right? Where people can feather in expenses and things, right? And you have to look at the revenue numbers and say, does that make sense? So I'll give you an example. So we were looking at a property management company. And so the revenue in 2020 was substantially less than it was in 2021. And we were like, or I'm sorry, 2019. And so we were like, well, what's the difference? And he's like, oh yeah, that's when the companies were together. Now they're segmented. And it's like, well, how do we know what the revenue for this particular branch of that company was, right? And so I think, you just really need to look at things, and it's probably very similar to multifamily in the fact you just need to continuously look at deals over and over again. And I highly recommend finding people that are doing what you want to do, right? Who are people that have acquired businesses? There's a lot of great books out there that you can read about due diligence. There's a lot of podcasts that are very similar. I'd say with businesses, the barrier to entry is much lower than it is with multifamily. And I think that's what, is kind of appealing to some folks is, hey, can I get to spin up this side hustle or this business through acquisition versus just trying to stand it up? Because the stat that always stands out in my head is 2% of startups succeed past 5 years, whereas businesses that are acquired, over 90% of businesses that are acquired succeed over 5 years, right? And so I think that's kind of, my thought process is, I'm not smart enough to create the wheel and reinvent it. Why don't I just go buy someone else's wheel that's already been successful, right? Product market fit's kind of the big one. Just product market fit would be kind of similar to evaluating a multifamily market, right? Is this market growing or is it shrinking? Is there really an aptitude, or is there a depression in the amount of housing volume, which, the answer for most places right now is yes. But I hope that gives some answers, but obviously it gets very intricate and specific on a specific opportunity. Do I underwrite the deals myself? So if not how and where do you get someone to work doing the underwriting? So I've always underwritten my own deals. So a lot of people outsource the underwriting piece, and I've never really understood that, because if I'm going to be investing in something, and especially if I'm going to be bringing on someone else's capital as an investing partner and a capital partner, I mean, I feel like I need to understand those nuances to a T. So I have people that just in the space, networking through networking events, or I've paid people before through mentorship and coaching as well to kind of help me further evaluate deals. And so I feel like I've gotten to the point now where I have the aptitude, not that I'm an expert or a pro at it by any means, but I think I have the aptitude to do that. But that would be my recommendation. But I've never hired like an analyst or just an underwriting person to underwrite all my deals for me. But again, especially depending on the size of deal you're looking at, the underwriting's so different, right? So I'm primarily looking 10 to 70 units in Central North Carolina. If I was looking at 150 or 300 units, it would be substantially different. And how do you outsource them? Outsource what part?
Probably the underwriting. And there are actually people who will underwrite for fees. Is that what, Tabitha, is that what you're asking?
So what's the one? Bullpen? Is Bullpen the one? I think that's the one. It's like a new tech startup, and so you can actually hire like an incremental person, right? If you're like, hey, can you underwrite this?
That's what I was asking. Yeah, if you outsource it, how do you outsource it? There's a place where you can get underwriting outsourced.
So yeah, I've never done that personally, but a lot of people that will, a lot of people hire like an analyst, right? Like to do that. And obviously if you're just trying to underwrite individual deals. So there's this company called Bullpen. I've never used them. I know a lot of people that have. I believe it's called Bullpen. It's in San Francisco, I think, or Boulder, Colorado or something. But they have hourly, it's kind of like a staffing agency or a consultancy for people within commercial real estate. And so I know people that they go and they hire somebody from this consultancy to underwrite the deal. I don't think it's cheap. I don't think it's astronomically expensive, but I guess that would be a place that I would look at. I've never used it personally, but I know people that have, but they're underwriting more institutional type deals or much larger syndicated deals. On the smaller deals, I'm still just kind of doing that stuff by myself, but I think Bullpen's what it's called. And I think that would be helpful.
I do know of at least one person that does do that, a former multifamily investor, and underwrites for an hourly rate. So if you shoot me an email, I'll definitely send that information over to you.
Okay, definitely. Thanks.
Cool. Yeah, so dude, that was pretty good. We're right around the 1 hour mark. So unless anybody has any other questions, Sharon has one here. The underwriting speaks to your management strategy. Okay, I guess it's more of a statement than a question, but it's very true. I think, going back to the original question, talking about partnering, I think like anything, you have to understand everything in the business. And then, if you do partner, there are going to be synergies that you're looking for, whether it's, one person, as you mentioned, likes to get out there and talk to brokers, and one person does the underwriting. So I think that's the key with the partnering. Garrett, sorry, you had a question?
Just one quick question. John, you mentioned earlier you were cold calling property owners when you were looking for real estate. Is that how you find a lot of your deals? Are you going through sourcing lists of local owners and reaching out directly?
Yeah, I'm kind of hard-headed and stubborn. And so, I was like, these brokers can't be much better than I am, calling and talking to these people, they've got the relationships on their side and they've got the market, right? Because when you're calling somebody, you got to be under a rock, or I don't even know. I think you got to be under dirt right now to not know how hot apartments are, and because that's what the majority of people that I call. First of all, I was shocked at how many people picked up the phone. I've got an out-of-state area code, and so I'm like, why are you picking up my phone call ever? But, you think about some of these older property owners, especially during COVID, they're stuck inside all the time. They're not talking to a lot of people. And so I was really blown away by how many conversations I had, and, not even like companionship, but to an extent, it was like, hey, here's somebody calling me, they're not a telemarketer or whatever, they're probably kind of crazy, but they're at least from the US or whatever. And so, but yeah, so I initially started with ListSource, which is fairly inexpensive. The challenge with ListSource that I didn't realize was how many filters there are. And so I spent hundreds of dollars wasted on, picking the wrong filters, and many of the properties were worthless, but it gave me kind of that step in the right direction. And so the product I use is Reonomy now, so it's a little bit expensive. I think it's like $3,500 for annual license. But the thing about Reonomy, the reason that I decided to spend that much on a tool like that was because I thought even just driving for dollars, like if I was driving a couple target markets, I mean, a couple tanks of gas, if I was there 20 hours, what's my time worth? Now I can just pull it up on Reonomy, and, it's got Google Maps kind of integrated into it. And so, but yeah, so that's what I did. There's a lot of free tools out there as well. True People Search, Fast People Search, that you can use to look up owner contact information. Reonomy actually gives you, and they do like a 7-day free trial. They don't do any type of affiliate stuff, unfortunately. I was like, hey, I'd love to champion you guys stuff. So I'm just, throwing that out there because I'm, that's what I use. But yeah, that's what I've been using. And like I said, I mean, I was working on a couple other deals earlier this year, like a 46 unit deal. And this other guy was like 180 units. And I think the market's so strong right now for the way I'm trying to buy properties. I've got to talk to the owner directly. The ironic thing is somebody that would have sold off market pre-COVID is the same person that will sell off market today, right? There's going to be some sellers that just are totally old school, and they're just going to want to have more of that personal relationship. It doesn't have to be best, highest and best. A lot of these people are just like, it's a thorn in their side. And, either they fully depreciated it or they inherited it and they don't want it. And so I'm looking for the type of people that the pain isn't the highest price, the highest price sale price that they can get on exit. Right. And to my, shock and disbelief, not every multifamily owner is looking for the highest and best offer. They don't want 50 people snooping around their property. They want to do it with somebody that's a smaller company that's going to kind of take care of it as they have for all this time. And so that'd be my recommendation to folks out there. I mean, it's a lot of challenge. It's a lot of work, but I was fortunate enough to land some pretty good stuff from it. And, and again, it's a long game, right? So it's like, these people that I've talked to, they might call me in 5 years, maybe I'm not even doing it anymore. They're like, hey, we talked to you 5 years ago. Do you want to buy it? And so I think that's the thing, is like, I'm starting to cycle through, and it's like building relationships with these people so that when they are ready to sell, maybe they're not going to sell to me, but then maybe they'll give me a crack at it kind of scenario.
And this is right in your local market. You're calling people.
So I tried my local market. My local market's pretty aggressive. So Raleigh-Durham's one of the top markets in the country. And again, same thing. You got to be under 6 feet under to not realize how strong of a market it is. And so I started trying to hit Durham pretty hard initially, but it had already kind of gone past by the time I was attacking it again. Back to I wish I started a few years earlier, then I would have made some really good money like my buddies did. They were smarter than me. So Greensboro and Winston-Salem, North Carolina are my primary target markets. I do attack Fayetteville. And then there's it's not even tertiary anymore, but outside of Chapel Hill, Alamance County, Burlington, and Graham area is starting to kind of combine Greensboro and Durham and Chapel Hill area. So that's where I'm attacking as well. So it depends how you define market. So, I'd say, within an hour and a half of where I live, but yeah, within the state bounds, I'm not going to out of state yet. Not that I'm against it. I feel like I haven't given everything I can in North Carolina. So I feel like I owe it to myself to try to drive there first. And then if I have to fly there, I will.
Right. Thank you.
Excellent. So yeah, listen, John, I don't want to take too much of your time. I know keep it to an hour, and then function. I do 20 minutes of networking after this in breakout rooms. And that was awesome. That was awesome. So again, everybody wants to get your information. You had it on. I'll copy and paste it, your email one more time. And definitely appreciate you